So back on March 18th, the Federal Reserve dropped an announcement that honestly looked like a total snoozer. But buried in all that official jargon, there's a real puzzle. And in this explainer, we're going to put those pieces together and figure out why a simple pause has everyone on Wall Street so spooked. First up, let's look at what they actually said.
All right, so here's the headline news. The Fed's big decision-making group, the FOMC, they decided to just hold steady, no change. They're keeping the federal funds rate right where it was, between 3.5 and 3.75%. No cuts, no hikes, nothing. Now, usually when the people in charge of the world's money say no change, that's a good thing, right? That's comforting. Well, not this time.
So what gives? Why is the market suddenly so nervous? Because underneath that calm surface, the economy is getting hit by two huge shocks at the exact same time. And the Fed basically just threw up its hands and admitted they're not quite sure what to do. To really get why everyone's so anxious, we got to dig into the threats that have the Fed backed into a corner.
All right, let's dive into threat number one. This is an old-school problem, a classic economic villain that's come roaring back, a huge spike in the price of oil.
And we're not talking about a small bump here. We're talking a 50% jump in crude oil prices, all thanks to geopolitical conflict flaring up in the Middle East. This isn't just a tiny blip on a chart, it's a massive jolt to the system. It hits everything, from what you pay at the pump to the cost of getting, well, anything delivered. It hits your wallet, plain and simple.
So why is this such a big deal right now? Well, remember, the Fed's number one job is to keep prices stable. They're aiming for that sweet spot of 2% inflation. But here's the thing. Even before this oil shock, their own meeting notes said that progress on inflation was, and I'm quoting here, absent in recent months. So this energy spike, it's like pouring gasoline on a fire they were already having a really hard time putting out.
Okay, now for threat number two. This one is way more modern and honestly a lot trickier to get your head around. We're talking about artificial intelligence. AI isn't just a tech story anymore. It's become this huge, unpredictable economic force that no one really knows how to handle.
And this is where you can really see the Fed's big AI headache. On one hand, you have the promise, right? The long-term dream of higher productivity, more growth, all the good stuff. But then there's the problem, the thing the Fed has to deal with right now. And that is, this AI disruption is already causing real credit stress in some parts of the economy, and it's making companies hit the brakes on hiring.
And look, this isn't just some theory. This is a direct quote from the Fed's own meeting minutes. They are hearing straight from businesses that firms are delaying or even cutting back on hiring because they're getting ready for AI. They don't know what's coming, so they're waiting. And that right there hits the other half of the Fed's big job, making sure as many people as possible have jobs.
And you could already see the financial cracks starting to show. The software industry, the one that used to be the star of the market, well, now it's the canary in the coal mine. The value of their loans is dropping fast. And at the same time, you've got investors yanking their money out of the private credit funds that are loaded up with these tech companies. You're looking at the start of a potential credit crunch, and it's all being kicked off by this uncertainty around AI.
So think about it. You've got these two massive threats hitting at the same time. One is pushing inflation up, that's the oil. The other is threatening jobs and credit, which could pull the economy down. It's a total mess. And it's forced the Fed to basically tear up its old playbook and start talking in a whole new way.
Now, to really get this shift, we need to talk about something called Fed speak. It's basically the special, super cautious language the Federal Reserve uses. It can be kind of cryptic, but traders and economists hang on every single word. Why? Because changing just one word can signal a massive policy shift, and that can move billions or even trillions of dollars around the globe.
And here's where we see that Fed speak in action. For years, the Fed's favorite phrase was data dependent. It's pretty neutral, right? But now, they've swapped that out for two new key phrases, nimble and two-sided risks. Nimble is their way of saying, hey, we might have to move fast without a lot of warning. And two-sided means they're worried about both things at once, inflation taking off again and the economy hitting a wall.
So what's the big takeaway from all this? It's that the Fed isn't giving us a roadmap anymore. That whole era of forward guidance, where they'd pretty much tell us what they were planning to do for the next few months, that's over. Gone. Now, they're just flying by the seat of their pants, making it up meeting by meeting. And that injects a huge amount of uncertainty into everything.
Okay, so let's bring this all home. It's time to solve the mystery we started with. Why is the market freaking out when the Fed officially did absolutely nothing?
And here it is. The answer is that the market's safety net is gone. That old, reliable idea of the Fed put.
You know, the belief that the Fed would always ride in and save the day, it's vanished. These twin threats, oil and AI, have created what one report is calling extreme policy uncertainty. Bottom line, nobody has a clue what the Fed is going to do next.
And this uncertainty, it's not just on the outside. The Fed itself is divided. You can see it right in the vote count. While 11 members voted to hold steady, one guy, Stephen Miran, actually voted against it. He wanted to cut rates right then and there because he was worried their current policy was already starting to hurt jobs.
And this uncertainty has caused a massive, violent shift in what the market expects. Just check out this chart. A few months back, everyone was betting on rate cuts this year. It was a sure thing. Now, poof, those bets are completely off the table. And here's the real shocker. The market is now pricing in a 30% chance that the Fed's next move isn't a cut, it's a rate hike.
So this is the new reality we're living in. There are basically three ways this could go. The base case, the Fed just stays on pause, caught in the middle. The hawkish surprise, they actually hike rates if that oil shock makes inflation get out of control. And the dovish surprise, they're forced to cut if the AI slowdown starts killing too many jobs. All three of these are now very real possibilities.
So we end up right back where we started, with this puzzle. The Fed is standing still, but only because it's being pulled in two opposite directions with incredible force. And that leaves all of us with a really unsettling question, the same one every single investor is asking themselves right now. In this new age of extreme policy uncertainty, who exactly is flying the plane?